So today we are going to be looking at investment properties, how to analyze them, specifically the individual properties, but then also how to take a look at an investor's needs and wants list and figure out what would make a good investment property for them. So if you want to follow along, in the email I sent out today, had a link to the investor sheet. The investor sheet is one of the spreadsheets that we use when analyzing properties. And this particular one, it's got a lot of details, a lot of information in the spreadsheet. And so we'll kind of go over a little bit how to work the spreadsheet, what some of the data in it means, and how to better utilize it when specifically analyzing an investment property. But first, what we're going to do is we're going to assume that we have a specific property that an investor has given us, and they say, hey, Nico, I want to invest in this property. Can you run some numbers? Does it make sense for me to buy this property? And then after we do that, then we're going to work backwards and figure out, okay, how do we get to that point? How do we even figure out whether or not this was the right property to invest in? So to start, we got the investor sheet up, and we also have the specific property pulled up as well. This particular property in Brandon, it's a townhouse. And so what we're going to do with it, with the investor sheet here, we start, you'll see on the bottom we have a couple different tabs. We have the net sheet, the renovation costs, the rent roll, the pro forma, the amortization table, and the historical data. Really, the ones that you're going to be focusing on most are the net sheet, the renovation costs, and the rent roll. And with the net sheet here, the cells highlighted in yellow, those are the ones that we're going to be updating the most often. So for this particular example, we have a specific property. So let's assume it's currently listed at $125. For now, let's just assume that we're going to be buying it at the list price. There's a couple things that we need to, when we buy a property, we know a couple things with it. So we know whether or not the investor is looking to use this property as a rental property, whether or not they want to hold on to it for a couple months, a couple years, or we know whether or not they want to fix and flip it up. This net sheet will allow us to do either one of those models, whether or not they want to fix and flip it, whether or not they want to rent it out. The only difference is with the fix and flip model, we won't have any rental income or rental expenses. So if your investor is looking simply just to fix and flip it, we can ignore the rent roll, essentially put 0 for the rent roll, and then 0 for all of our operational expenses, because we don't have any ongoing operational expenses for property management services. But for this example, we are going to assume that this renter or this investor is going to buy this property to hold on to as a rental property. Knowing that information, then we need to know, okay, well, how is the investor going to pay for it? Sometimes the investor is going to pay that with cash. So if we know that the investor is going to pay with cash, we know that the down payment percent is going to be 100. When the investor is paying with cash, your closing costs are going to be less. So if your average closing cost for someone buying a home with a mortgage is about 3%, we know that someone paying cash, it might even be as low as 1% or even. So that's something that we need to be aware of, is how are the investor going to be paying for this particular property. For our assumption, we're going to assume that the investor is using a mortgage. Investment type of mortgage where they're required to put at least 33% down, and that, and so they were good there. So we know the purchase price, and we know the closing costs that the buyer would be expected to have bring to the closing table. Which also means, since we know the down payment amount, we can figure out, okay, what is their initial upfront costs? And as we look, figure out what the lifetime operating costs are going to be, we can figure out what those costs are going to be. If we then figure out, okay, so let's say this particular property, it needs some work. So how do we determine whether or not a property needs some work? Well, that's a very subjective question. A lot of that we can go back and forth and figure out, okay, if we do no work to this property whatsoever, we could rent it at X. But if we do some work to this property, now we can rent it for $300 more a month. We then just have to figure out, okay, what is an acceptable amount for us to renovate this property, if at all? So one of the things that, as real estate agents, as we're touring the property for the investor, whether it's online or in person, we should be getting a good understanding of, okay, what does this particular property need as far as any renovations? And then what is the community expectations for this particular property? So if, every home in this particular community, all the kitchens were last renovated in 1990, and our kitchen was last renovated, in 2010, then we know, okay, our kitchen is a little bit better than our comps. We probably don't need to touch the kitchen. Even if the kitchen needs some work, we know it's still better than the comps. But if all the kitchens in this community were renovated in the 1990s and our kitchen from the 1970s, then yeah, we probably need to renovate our kitchen just simply to keep up with the comps. So there's a couple different factors when we look at renovations. Not only how does it affect the individual property, but then how does the neighborhood comps also affect this particular renovation? So as we're looking through the pictures of this home, kind of good sense of what it looks like. And again, it looks like we got a kitchen from maybe the late 1980s, early 1990s. Got tile floor. So, as we take a look at this, we say, okay, it's functioning as it is today. But there are obviously some upgrades that we could potentially make to it. Little upgrades as far as updating the appliances, to larger updates, maybe like refacing the cabinets, replacing the cabinets, taking out the soffit lights. There's lots of different levels of renovations that we could potentially do to this particular property. Same thing too when we look at the other rooms in the home. Especially when we start to go towards the bathroom and upstairs. We have older carpeting, we have blue carpeting, you have pink carpeting. I'm sure that carpeting is a little bit dated. Some of the bathroom, fixtures and finishes are certainly older. And so as we look at that, we say, okay, not only does that affect our purchase price going in, it affects then our rental price on the back end. So, we can get a good understanding of, if we kept everything today, here's about what we expect to pay for it. Here's about what we expect to renovate it. But if we do some renovations, here's what we can expect to get for it on the back end. So kind of taking a look at that and knowing that information, we can go to our renovation costs tab. So if we go to our renovation costs, we get a couple of different factors that we can estimate. So part of what we do with the investor sheet on the net sheet is we include the square footage. The square footage is a great way to determine some renovation costs. Obviously, you can do price per square foot when you're purchasing properties, but I'm not a big fan of using that analysis. But as far as construction and renovation, it's pretty useful. So there's a couple of different tools that we can use when determining the construction cost for a property. There's the quick estimate tool, which is simply this first line item here, and then the grand total tool, which is a little bit more detailed analysis of the construction costs from both the interior and exterior perspectives. But let's say, we don't want to do a full detailed, construction estimate. We just want to take a quick look at things and figure out, okay, how can we possibly upgrade this home? And so with that, we know that we have, 1252 square feet in this particular unit. And then we need to figure out, well, how much would renovation cost, assuming that we decide to do some renovations to every room in the property. Well, we have our quick estimate guide to determine, okay, what is the different levels of finish that we could possibly do? So let's say you just wanted to do, investor grade, builder grade renovations. Well, then we know our cost per square foot for renovations is going to be about $27, which means for this unit, assuming we touched every floor, every room in that house, our construction costs are going to be about $33,000. Let's say we wanted to put in the maximum type of upgrades necessary and go out and do luxury. We know that we can spend about $87,000 in this home. Now, if this is an investment property, I probably wouldn't recommend going all out, especially if this property is only valued at $125. We don't want to put $90,000 in renovations. That would be over renovating that house. So with that, a lot of times for your investors, you're going to be anywhere between $27 and $35 per square foot. And with this room, with this particular unit, you're probably not touching every room in the house. So let's say maybe we're only touching 800 square feet of it, and we want to do a low-end finish. That gives us about 24 grand to update kitchens, bathrooms, floorings, paint, things like that. That's a pretty conservative estimate to be able to do a lot of good things with this particular property. So with that, we have 24,000 here. So the only two numbers that we need to really touch here are the square foot units and then the unit cost of this particular property that we know those are the ones that we need to adjust. And then automatically that number, that renovation costs, is going to pull from that tab and be entered into our spreadsheet here. So now we know as an investor, okay, now we know what the purchase price of the property is, how much our closing costs are going to be, what the renovation costs are, and then what our down payment amount is. So now we have our cumulative costs as far as, what our down payment amount, renovation costs, closing costs on the purchase side, and then potential closing costs on the sell side. We get a good understanding of, how much cash is this really going to take for us to be able to do something like that. So let's say our investor had an overall budget of $200,000. Well, knowing the down payment amount, knowing the renovation costs, closing costs, now we can give a rough estimate to the investor to say, okay, if your overall, total cap on investment is $200,000, this particular property would match that number. We'd be less than that. So we're good to go there. So the next thing that we need to figure out is if this investor is looking to purchase a property to rent, and we want to rent this property out, we need to figure out, okay, what is an acceptable rental rate? So figuring out rental rates is very similar to, searching for comps when we're looking for, for sale prices and purchasing prices. So a couple things we'll look at. We'll take a look at where this property is, what type of property it is, and how big, and some of the stats. So we know it's in 33511. It's a 2.5 townhouse. That's about 1,200 square feet. So when we're pulling some rental comps, what we're going to be looking for is we're looking for active comps on the market and leased comps within the last year. The reason we say the last year is because the contracts for rental properties are typically a year long, and so things that leased in 2018 and early 2018 still would apply today because that contract is ongoing. So we're looking, active and leased properties within the last year in this particular zip code for this particular property, and it is at least 2-bed, 2-1, and so we have almost exact comps. We'll say 2 beds, 2+ baths. We have at least 48 possible properties that match our description. And so with that information, we can pull some really quick numbers and figure out, okay, if we're just going to run some statistical analysis and figure out some details on this property, we know that we have 7 active properties and 41 leased properties. Well, the average for active properties, their list price is about $1,293 a month, and we know the average and median leased price for a townhouse like that in that particular is about $1,250. So we know with a pretty good level of certainty that about $1,250 is going to be what our lease rate is for this particular property. So if we know that information, we are going to plug that into our rent roll here. So the rent roll tab here is going to help us to determine what each unit is going to rent for. Now with this particular unit, since it's only one townhouse, we only have one renter, we only need to worry about one line item here. So we have one unit at $1,250 per month. This spreadsheet is automatically going to update. So the total monthly rent that we're going to get per unit, and then the annual rent per unit. Now let's say we're looking at a duplex and we have unit A and then unit B within the duplex. There's one unit of each. Maybe one unit is going to go for $1,000 a month, and then the other one is going to go for $1,200 a month. Well, now this rent roll is going to calculate, not only the rent for the individual unit per month, but then for all of the units the entire year. And that information gets automatically plugged back into our net sheet calculator. So that way we know how much monthly rent we can expect from all of the units, and then what our annual rent is going to be from all of the units as well. So the rent roll is pretty important. We can do up to essentially 18 different types of units. So if you're looking to buy an apartment complex and you have 1 bedrooms, 2 bedrooms, studios, at different price points, different floors, now we can start calculating, okay, what each unit is going to rent for. But since this one is just simply a one unit property, we only need to worry about the townhouse itself, and we know that it's going to rent for $1,250, which means we're going to get about $1,500 a year in rent, and that information is automatically plugged into here. A lot of that, when we talk about low finish versus lowest finish, or high finish versus highest finish, so a lot of that has to do with the type of materials that we're putting into a home. And so let's say with granite, for instance. There are 5 different levels of granite, going from level 1 to a level 5 granite. Level 1 being your basic, inexpensive granite that's pretty much mass produced that you'll see in most cookie cutter homes. Level 5 being a very specific custom piece of granite in a custom multi-million-dollar home. And yep, exactly. And then every single material in a home has essentially a roughly level 1 through 5 variety. Your kitchen cabinets can come in a pretty simple square box. Trim, just a flat door. That might be your lowest level finish. Whereas if you have a pentagonal shaped box with custom edges and belving on the doors and unique knobs, that might be a higher level finish for the particular cabinet. And so essentially looking at every type of material within the home, do you want a super nice fancy version, or do you want a simple investor grade box essentially? And so again, these are rough guides. It's not necessarily to say you could spend more or less on these, but essentially if you're an investor, you probably don't want to put high-end luxury finishes. You want to put basic the quality finishes that could last but that aren't very expensive. And so this is just a good understanding of look, if we wanted just the dirt cheap lowest possible thing, we'll know it's about $27 a square foot. If you want something that's really inexpensive but a little bit better than the least expensive item, then we're going to go about $30 a square foot.
Where does the height of the cabinet come from?
So that again, it depends. You could have a tall cabinet that is very simple in design, but because it's a little bit taller, it might be a medium to low finish. Right. And that's why if you wanted to do something a little bit more detailed instead of the quick estimate, let's say you want to renovate a full kitchen, you want to renovate a full master bathroom, you have 2 other bathrooms that you want to renovate, you're doing all of the flooring, all 1,252 square feet, then we can get a little bit more detailed on the cost. But the quick estimate is just to say, look, if you want something quick, easy, inexpensive, it's going to cost you this. Or if you want to go a little bit higher end, it's going to approximately cost you this. So with that, we got some initial numbers down. We got our purchase price, closing costs, rent. We know our down payment. The investor's going to put about a third, 33% down. Next, we need to figure out, now because we know that they have a mortgage, what are some of the terms of the mortgage? And now with investors, that can be a little bit more tricky to determine because it depends on the type of home, it depends on the type of investor, what type of mortgage that they're using. So in this particular spreadsheet, we have 2 options that an investor could do. For an investor that's holding on to this property as a rental property, we don't need to worry about the loan fees and the interest-only versions of this. For an investor that's looking to fix and flip this property, a lot of banks that are offering mortgage products to investors will have an interest-only loan for a certain amount of time. And then after that, it becomes interest and principal in your payments. And so we can kind of figure out which type of investment the investor wants to use, and then figure out, okay, what's the calculation on the mortgage, depending on what that is. But for this instance, they're looking to rent this property out, so we don't need to worry about a loan fee on this particular one. The interest rate and the term of the loan are going to be what's most important. And so let's say, for example, this investor wants to hold on to this property for the next 20 years. They're looking to get long-term value out of this, looking to collect rent for the next 20 years. And they understand, the $83,000 loan, I can probably pay that off in about 10 years. So they want a loan term that's about 10 years long, knowing that they're going to hold on to the property for about 20 years. Interest rates for a mortgage on a property that's being an investment are anywhere from 1 to 3 points higher than what current market rate is for a typical mortgage. So mortgage rates right now are hovering around 4.5%. Then maybe our mortgage for an investor might be 5 3/4, 6% interest rate. This is again an estimate. We'll get much more specific numbers from a particular bank if we present them these numbers, but at least we can estimate. Let's say we even estimate on the high side that they're getting an interest rate of 6% for the next 10 years. So we'll know that information right up front. Then we're going to get into the understanding the operating costs of a rental property. What are those things that are fixed every single month that we're going to have to pay for, whether we have a tenant or not? And what are the things that we're not going to pay for if there's no tenant in there. And so we break those down into our fixed operating costs and our variable monthly operating costs. Obviously, we know that we have principal and interest. We have to pay off our mortgage, and then we also have other fees that we have to determine. So a couple quick easy ones that we can figure out with the MLS. Is there an HOA on this particular property? And so for this property, we know that yes, there is an HOA that charges $325 a month. So that's information that we're going to have to enter into this spreadsheet, that we know $325 a month is what we expect. For homeowners insurance for a townhouse like this, similar to a mortgage, we can get an estimate from insurance agents to figure out what approximately the cost is going to be. But for our example, we know for this type of townhouse, for this age and this size, we know it's probably going to be anywhere between $100 and $150 a month for the investor to have insurance on this property. So we're going to say $125 per month. We can also look at the taxes to figure out exactly how much those taxes are going to be. So in 2018, your annual taxes were $684. So we know that 684 divided by 12 is $57 a month. So when we enter our spreadsheet here,
this girl has major surgery Tuesday at noon.
$57 a month.
Yesterday morning. 1 day in the hospital.
One day fine. So it's about 0.5% of our purchase price. So that's what this cell here is highlighting, that typically we can determine the monthly property tax rate as a percentage of the purchase price. And that's essentially what this cell is figuring out here. So when you're figuring out what the monthly rate is, enter it as a percentage, and that'll help you determine what that monthly property tax is going to be. The administration fees, that's just that, administration fees that an investor is going to have to pay for to handle paperwork and things like that. So now with that information in hand, we have some fixed costs for the first month, assuming that it was an interest-only loan, and then what we can expect are fixed costs moving forward. That's, again, no matter what, we have a tenant or not, we have to have that information. Now let's assume we have a tenant in there, and what are our monthly costs? Well, based on some of the things that we know about property management, these are some of the variable costs that we're going to have as the landlord. So we know our monthly property management fee, we know a tenant placement fee, it's a one-time fee, but this is then distributed over the 12 months. Vacancy and collection. So that's something that's also important too, that we have to determine, when there's a home that's just sitting with no tenant in it, we are going to have some costs associated with that, trying to figure out, we have some temporary utilities that we have to pay for. We have the fact that we're not collecting rent. It's a good idea to set aside some money every month in your operating account. So that way, when you do have a vacancy, you can use some of that savings to help pay your regular costs down. So again, this is not something that we have to include in our numbers, but I highly recommend that we do. This 95%, that is the occupancy rate for rentals for all of Tampa Bay for residential. It's a very good renters market. We could even put that number a little bit higher at 97%. And then we know, the likelihood of us renting a unit is pretty high. If we know that let's say buying properties becomes very, very popular, not many people rent, that vacancy rate might go to, or occupancy rate might go to 80%, in which case we might have to put some more money in our savings account. But let's say right now it's a very popular rentals market, and we know that we're going to have a really good opportunity to rent this. Capital expenditures, replacement fund, and general maintenance funds, again, these are optional but recommended for a landlord to keep, in that every month you put aside some money from your rental income, put it into savings. So if you do ever have to pay for repairs or maintenance or things like that, you have some money set aside not only for general maintenance, but also larger expenses. Since this particular unit is a townhouse, we don't necessarily have to have that much stored up in our capital expenditures, because a lot of what the HOA fees covers a lot of the capital expenditures for the particular community. But things like, if we want to upgrade all the appliances, or wanted to repair or replace all of the carpet in the unit, that might come from our capital expenditures replacement fund. Versus if the AC breaks one month, that money might come from our general maintenance fund. So that's kind of a understanding of the fixed operating costs and the variable operating costs per month with a rental. Let's say your lease ends March 31st and you don't put another tenant in until, April, then in the course of your previous lease, if you're setting aside, $37.50 every single month, yep, when you don't have a tenant, now you have some savings to help cover your mortgage or, your HOA fees, things like that. Yep, so a tenant placement fee. So for a landlord, typically a property management company will charge either 100% or 50% or some sort of percentage of the first month's rent in order to secure a tenant for that unit. And so since this is over a monthly time period, what we did is we divided that tenant placement cost over 12 months. Now, obviously, you're going to have to pay all of that in month 1 and then never have to pay it months 2 through 12. But to better average it over the course of a monthly rate, this is what you can approximately expect. Yep, that's correct. And some units, when they have the CDD fee, they include it in the property tax bill as well. So you just got to make sure that if a home does have CDD fees, you're not calculating it twice. Okay, so we got that information. So we have our information now as far as purchase price, closing costs, renovation costs. We know about what it's going to rent for. We know how much we can expect on our mortgage costs, our admin costs, and then our variable costs every month. With that information, then we know, okay, this investor wants to hold on to this property, they said, for the next 20 years. So we know that information here. We can enter that information. They want to hold on to it for 20 years, which is about 240 months. So that means we know everything about this particular property from the start, from today, February 2019 to February 2039. We can get an understanding of how much the down payment was, what the renovation costs are, what the lifetime operating costs are going to be, and then what the closing costs are when that investor decides to sell their property in 20 years from now. And so with that all information, then we can also figure out, okay, what are the expected expenses with that particular property too. So that's how we figure this out with the pro forma. So this pro forma sheet gives us an understanding of a big picture overview of all of our income, all of our expenses on an annualized basis, as well as a cumulative basis. So we know that, with the information that we have, the rental rate, the cost, and things like that, every year, this investor is going to be losing about $5,500 per year. And now we know that's when they have a mortgage. Now in year 11, they no longer have a mortgage. And so in which case, since now instead of having to pay off that mortgage cost, now they don't have that. That principal and interest payment goes down to zero. In which case now they can, start to accumulate some profit. And so after 20 years, we know that, assuming we pay down all of the losses, at year 19, this property has become cumulatively profitable. And at year 20, assuming that we rented it out for all 20 years, we know approximately how much we can make every year and how much we can make cumulatively. The good thing about this is that this pro forma also includes inflation. So if we know that rent is going to go up, let's say 1% every year, it calculates, okay, 1% increase every year, what does that look like? If we know rents are increasing really fast, what if they're increasing 4.5% every year? Well, then it might be a little bit quicker that we start to make money. Maybe instead of year 19 that we're making money, now it's actually, right after we're finished paying off our mortgage in year 13. Now we're starting to make some money too. So a lot of these assumptions, we can change to figure out, okay, if these assumptions happen, this is what we can approximately expect to make. It's also saying, if homeowners insurance goes up, if property taxes go up, if HOA fees go up, all of these different things. Also, we can take a look at, maybe we don't want to put any money into, our CapEx and our general maintenance fund, save $100 a month. How does that then factor into our pro forma? Instead of losing $5,500 a month, now we're only losing $5,500 a year. Now we're only losing $4,300 a year, in which case our break even is much sooner. So all that being said, this is a living, breathing document. It's not just something that we take a look at once, only enter one data point at once. Everything is fluid. So anytime you see information here that doesn't look right or that's not adding up, we can kind of go back and check some of our assumptions and say, okay, what needs fixing? What doesn't work? Why doesn't it work? And then if we change some of our assumptions, how can we make these numbers work for our investors? So then it becomes 20 years later, it's 2039, the investor decides to sell the property. How in the world are we going to figure out what the resale price of that property is going to be 20 years from now? Well, that's what our historical data sheet is going to help us determine. So going back from 1993 to 2018, we know the median price for the greater Tampa Bay area in those years dollars. So this is in 1993, that is the median price point in 1993 dollars. And then 2018, this is the median price point in 2018 dollars. So then we can figure out, okay, what can we expect over a certain lifetime selling property? What can we expect as an average increase over time? And so we know that for the last 25 plus years, the average year-over-year price appreciation for the greater Tampa Bay area is 4.88%. In any 1 year stretch, the most anyone has ever made is a 26% return in 1 year. But in 1 year, the most that they ever lost was about 19% of the value of their property. We can also determine, so over any 10-year period, if someone is expecting to hold on to a property for 10 years, well, then they can probably, averagely assume that they're going to make about 50% price appreciation. The best 10-year period ever for the last 25 years made nearly 200% return. And then the worst 10-year period lost 25% of its value. And so, real estate is, and then these are the standard deviations if anybody is a statistical nerd. So this is a good understanding to an investor to say, look, real estate is a very good opportunity that you can make a lot of money over a long period of time. But there is still always the risk that, real estate is an investment and that there's the potential to lose money if you're not doing it correctly. But all in all, what we're trying to get from this information is, okay, in 20 years from now, or 37 years from now, or 6 years from now, however far into the future, what can we expect as an average price appreciation so we can get that information? Well, we know an average year-over-year price appreciation for Greater Tampa Bay is about 4.88%. And that's that information that we enter here, 4.88%. So that means if we bought this property today in 2019 for $125,000, if real estate continues the way that it has been for the past 25 years, 20 years from now, when our investor decides to sell this property at an average appreciation of 4.88%, in 20 years, you could resell this property for $324,000. So that means over the course of 20 years, they would have made, the purchase or the resale value plus all of the income that the investor made in rent. So that means over the course of 20 years, this investor received income of $654,000. But obviously you have expenses that you have to pay off. Since the investor paid off all of his mortgage, he no longer has a mortgage payoff. Well, let's say the investor only wants to sell the property 7 years from now. Well, since we know the loan term is 10 years, at the closing table, they're going to have to pay off the mortgage. So this information is automatically updated from the amortization calculator here. This information is already set. Nothing you need to do with this spreadsheet. It automatically inputs that information to our mortgage payoff as well as our principal and interest calculations. So we know that if the investor decides only 7 years from now they want to sell their property, still assuming a 4.88% price appreciation, 7 years from now, the price of that townhouse is probably going to be $174,000 that we sell it for. And again, we know how much money we made from an investment, from monthly rents over the course of 7 years, and then what our mortgage payoff is. So now we know the investor is going to make over the 7-year lifetime $250,000. But we know we have lifetime expenses, and that includes the accumulation of rent. So over 7 years, total accumulation of expenses would be all of our fixed expenses, all of our variable expenses, all of our debt servicing, as well as the down payment, and the renovation and closing costs. That's the easy part. That is the part where it's essentially just running the numbers. You know, if an investor says, Nico, I want to buy this property as an investment property, and I want to hold on to it for 7 years, and here's my mortgage, and here's how much I want to spend on all that. Does this make sense for me? Well, that is the one question that we as real estate agents cannot answer, because an investor would look at one particular investment. If we show this spreadsheet to 10 different investors, 5 of them would say this is a great investment. 2 of them would say this is a horrible investment, and 3 of them might say it's an average investment. You know, an investment for every different investor has different requirements. And so if one investor said, Nico, I don't care how much money I spend, I just need to make a 15% annual return on my investment. Well, if we run these numbers and show them that they're only making about a 13% return, the investor is going to say, no way, I'm not going to do it. But if someone says, Nico, I want to get a 10% return, and we show them something that's getting about a 13% return, they're going to think it's a great number. And so that's something that we have to determine at the beginning. What is the goal of the investor? Are they looking to make a percentage gain? Are they looking to make a net profit amount? Are they only looking to spend a certain amount of money? You know, what are those big picture criteria that they're trying to figure out? And then based on that information, then we can analyze a property and determine, is that going to fit your investment needs?